to another episode of our series COVID-19 From Crisis to Creation on Mentored TV. I'm your host, Patricia Falco Beccalli. In today's episode, we are going to take a look at the crisis in terms of financial markets, investments, and asset allocation. Where should you put your money in uncertain times? What about the recovery? Is there going to be one? Where is it going to be? And what about the governments and the policies in general that are being implemented to get our economies jump-starting again after it's been put on an induced coma a few weeks ago? And I'm going to discuss all of this with my very dear friend, long-term friend, I have to say, Carlo Besenius. He is a real bigwig when it comes to asset allocation. He resides in Luxembourg, and he's the founder of an asset management company. And with him, I'm going to discuss all of this. Plus, of course, what he thinks the market are going to do in the future. Carlo, thank you very much for being with us here on Mentored TV. And of course, you and I, we have a long history because we met back when I was still anchoring for CNBC, and we've kept in touch ever since. And I so value you to come here onto Mentored TV and really share your experience.
Thank you for giving me the opportunity to help you in this very critical effort that you're doing, which I think is something that I embrace totally, because I think there's a lot of ill information, disinformation, and also insufficient information and awareness when it comes to the current crisis that we have gotten in at a stage where the economies had already been rolling over around the world. And of course, this made it a lot worse. And so thank you for that opportunity. And I hope that I'll be able to help you and your viewers out to assess the situation maybe a little bit clearer.
Yes, let's get some clarity. And let's start off with a macro view. So let's go from the top to the bottom and start to drill down. A couple of days ago, I read a fantastic article on Bloomberg, and it had the headline "From Suppression to Depression." We just had the central bank here in Europe announcing interest rates are going to stay the same. Economic impact is going to be seen unprecedented levels. Plus, as well, they're going to continue to support a potential recovery. Can you give us a little bit of a round robin where we are in terms of economic activity or deceleration across the globe, looking at Europe, looking at the States, and perhaps also China?
Yeah. So there was, as I mentioned earlier, there was an evident slowdown in the makings already for basically since April last year. And you saw that in industrial production numbers, you saw that in PMI data, you saw it in inventory buildups, and you saw it also in the lack of inflation, which is something that central bankers, as well as a lot of investors, have not focused on or maybe not understood to the degree that one needed to. The central bankers have been fighting inflation now for the last 5 years, and with no apparent surges of inflation anywhere in the world. And so the lack of pricing power, really, and the lack of consumer demand is what has caused all of this. That has been happening very well before the coronavirus was first noticeable within China. And in Europe, whether it was in large industrial or whether it was in consumer, the same as in the United States, the slowdown was apparent. So we think that the world has changed due to the policy implementations that the governments have done consequent to Corona. And we actually think also that the consumer is going to continue to disappoint, and inflation is not going to be an issue to be dealt with. On the contrary, we think that there's going to be massive deflation over the next 2 to 3 years, simply due to the fact that the world, the United States in particular, but also Europe, has become very consumer driven. And that was all at the expense or with the help of the interest rates, long-term interest rates going down to zero. And the question is, where do we go from here? Negative rates are not going to stimulate necessarily consumption to go up. Negative interest rates may stimulate people to invest in businesses, private equity, and also in industrial businesses, but we do not expect that that is going to fuel consumption going forward. So then when you combine that with an enormous amount of unemployment rising, you've seen the data in the United States. For this week, we're expecting 3.5 million, 4 million is consensus.
We just had the numbers. We are over 30 million in 6 weeks, Carlo.
Okay, okay.
Yeah.
So, and our target was to go to 45 million unemployed in the United States. And this is something where I think a lot of economists are way too optimistic on once the economies are going to be restarted. In Europe, we're basically there within a couple of weeks. The bulk of about 80% of Europe is going to be restarted. In Europe, the layoffs have not been as massive for several reasons. We have much more protective employment laws here. We also have more government support when it comes to part-time unemployment, as well as unemployment subsidies by the government. But in the United States, just speaking to private businesses, private equity businesses also a lot over the last, and being involved in restructuring actually a couple of businesses already prior to coronavirus. Those companies that have been laying off people in the United States, and you know, my son has a company, it's an example. He had 70 people working for himself. With very little government subsidies, as an example, there is no way how he's going to go back to fully hire these people back over the next 3 to 6 months. The revenues and the profitability has to get there first before that there's a chance of full employment of the people that have been laid off. That's unfortunately the short-term social funding structure that the United States has, where there's going to be much more structural, many more structural issues going forwards than by comparison to Europe. On the other hand, Europe has another problem, and that is that we have almost double the amount of GDP coming from industrial manufacturing. And there, you know, the demand of the consumer demand dropping off, particularly for countries like Germany or like France, where automotive production is very significant. We have a very tough time seeing that over the next 2 to 5 years, we're going to see automotive demand go to the levels where we were on average on a monthly basis between mid-2018 and mid-2019, which was a normalized period. So with interest rates being at the bottom where we are, with zero in Europe and also pretty much zero in the United States, we cannot see from the monetary side how there can be stimulus coming. So it will have to come all from the fiscal side. And yes, unfortunately, there we see structural issues also. So
yes, and I think I would like to, before we just move into China as well, what you think is going to come out of Asia, considering it is so important for the export-driven economies here in Europe and also partially in the US. And Chinese GDP was down more than 6% as well in the first quarter. So not so good, not such good news on that front either. But the fiscal stimulus, i.e. The government's really giving money on one hand and also perhaps cutting taxes. Do you think what they're doing so far is any different to what they did in 2008 in the financial crisis? And will it be really doing the trick, considering that they're talking about debt, they're talking about loans rather than grants, and really just giving out money that potentially, especially small businesses, don't need to give back?
Yes. Well, two important points that you made there. The first one is that I think they have learned from the 2007 to 2010 crisis. I think they were quicker to deploy money. I also think that the amounts that they have deployed in absolute terms are bigger than in 2007, but in relative terms, so when we speak relative to the bigger economy, to the more complex economies today, and also to the magnitude of what is about to develop here, the amounts are insufficient. And you know, when we look at a really 2 to 3 year macroeconomic outlook here, we're seeing a total between 30 and 40 trillion dollars of GDP destroyed in aggregate for the global economies. And this year, probably around 12 trillion. Next year, another 8 trillion from the 2019, looking at a normalization rate. And then the following year, still, we're not going to go back up in 2022, 2023 to the GDP production that the world had experienced. So when you look at that, the amount that they have thrown so far between the Chinese government, the Bank of China, and between the Fed and between the ECB is largely insufficient in order to make up just for the GDP destruction that has arisen out of the implications of the corona policies and to shut governments down pretty much completely. So when you look at the global GDP, you have 80% of the global GDP coming from the top 20 nations. Those top 20 nations are not going to go back within the next 18 months or 2 years to produce what they have been producing as an average annual run rate of GDP in 2017 and 18. And that is really where I think that there's a lot more stimulus that is needed from the fiscal side. And one more time, whilst Europe has seen this better than in 2007 to 2010 and reacted better, the US is coming in with bigger subsidies, with bigger amounts of money. The delivery of that money into, as you said rightfully, your second point, is it going to the right people, the right companies, the small, medium-sized companies, which nevertheless are accounting for 70% of GDP in most of the G20 nations? No, it hasn't. And also the allocation currently, despite the fact that the US has recognized that they had technical delivery issues into that money, they still are not up to there are system failures, there are data processing failures, there's an enormous amount of trying to analyze who needs to get this money based on applications that they're selecting and that they're analyzing right now. And it's just a very, unforeseeable event, and it just will take a lot longer than the politicians, which are deciding on granting these funds, and the fact that these funds are being distributed to the right people so that they can keep their employees, or that they can at least keep part of their employees and produce.
In terms of really the stimulus packages, let's start focusing a little bit now on recovery, Carlo. And here, because we are both Europeans and very convinced Europeans as well, I wonder, I look at the packages coming out from the ECB as one block, 750 billion plus potentially another 500 billion, so over 1.3 trillion, I think, in terms of support. Sounds good. But on the other hand, you look at the individual countries that seem to have just different possibilities of really supporting their individual economies to jumpstart again and recover as fast as possible. And as far as I can see, you have this very distinct divide between the northern, more affluent countries and the southern, less affluent countries, such as Italy and Spain, perhaps also Greece. We haven't talked about that very much. However, and I wonder whether this kind of, difference really puts the monetary union of Europe at risk, or whether this is now really the time and the moment and the chance to really pull up the panties, as to say, as Europe, as one, and say, okay, let's deal with this as much as we can on a level playing field to be a strong force in a global economy, in a globalized economy, which eventually is going to continue.
That's a very important point that you brought up there, and I am not by surprise in total agreement with your initial views there. I always have been one of the biggest proponents of Europe, marketing many C-level executives of publicly listed companies in the United States, many government officials. And for basically since 1994, I've been hearing that Europe wouldn't have a shot to exist. You have had many economists calling for the end of the euro repeatedly since the 2000 introduction. And I have been one of the biggest proponents of Europe. However, the Brexit situation did put a damper on my enthusiasm. And nevertheless, after that, the British voted to leave Europe 3 years ago, a little bit over 3 years ago. I still saw that there was a steadfast understanding amongst more so the lower socioeconomic and less educated Europeans than there really was amongst a lot of the bankers and a lot of the investors that you and me are having as clients or having as friends. And that was encouraging because if you do have the people really, and from countries in Croatia where I'm very active and where I have employees to Italy to Spain, to believe that Europe would make it in spite of the Brexit started to get very strong. Now, of course, we have countries like the Czech Republic, like Poland, and also like Hungary, that are of a different persuasion at this particular point. And, there is rising criticism towards how Europe is allocating money and what Europe centrally takes as priorities as far as which countries, which socioeconomic problems go. And I think that is what worries me right now for the first time. So whilst I have never before been really worried about Europe, I am worried about Europe right now, because I think that the current political leadership, in the absence of Mr. Juncker and a couple of other, men and ladies with gray hair, I think that this is misunderstood and underestimated. And I think that we can resolve very quickly towards social fabric dissolvement versus 10 years ago, versus 7 years ago, versus the subprime crisis resulting into the European banking crisis. And I think that is not sufficiently taken into consideration by the current political leadership. When I look at the lack of public addresses that we see from Monsieur Michel, who's leading the Commission right now, in the biggest crisis that the world in the last 75 years has, we have seen very little cohesive European-wide leadership in all of this. That worries me. That is something that does not only worry me from an intrinsic European point of view, but also the way that the business partners, that the global business partners of Europe are looking at Europe, and that needs to change. That is something that I think is the utmost priority right now, that we get a cohesive and a very centrally focused response system that the politicians are putting quickly together, because that is something that is really not as good now as it was in 2007 to 2012 when we had that prior crisis.
Yeah, and I wonder, let's play a little bit of a scenario, and let's say you are the head of the European Commission, and how would you actually generate this cohesion in Europe? What do you think are the main pillars that people now just get the message and say, we are not stronger if we are going to be fragmented? We really have to get together. What would be the measures you would suggest, you would whisper into somebody's ear there? Or if you were at the helm, what would you do as a leader?
Yeah. Well, as you mentioned earlier, there are countries that haven't recovered at all yet, or only partially, from the 2007 to 2012 crisis that we have had. Greece as an example, Italy as an example, Portugal, and even other countries. Germany has recovered, but Germany also has other structural issues that they have to deal with, which are very much of a local issue. The same thing in France. And I think that this particular moment here, it would be one of the best opportunities for the politicians to come together, identify the top 5 to 6 priorities that need to be addressed, and actually come out and say, look, we have handled Brexit, even though it's not handled yet, but nevertheless, the UK is going to be, in a way, the lucky loser in all of this, because their timing to leave is actually giving them better options with response to the corona system and contributions that they would have to do into the EU to their own constituents. But for the rest of Europe, it would be very critical right now to come out and in one voice, the top leaders coming out, having Monsieur Michel as the leader, and basically addressing what the top priorities are. And of course, the migration issues are one that has to be addressed. The unemployment that is going to rise as a consequence out of this, it would be good to have a reassuring statement out of that. A much more central focused leadership from a central bank monetary policy, as well as from a fiscal policy, would be what should be discussed right now, and what, even if we don't come up with a final solution, I think now is the moment to do that. This is how you unify people. And I think that is being underestimate it. The moment is opportune, and you have to do it going into the crisis, not coming out of the crisis. Europe is always a little bit too slow to the plate when it comes to motivating people and keeping people together. And this is a moment where I would expect that some political think tank would actually advise the Commission to work on this and to do image improvement.
Yeah. Okay. Well, let's move it on, our conversation, Carlo. And I think I have to try to make sense between what we've just been discussing, large amount of uncertainty. Actually, if there is some certainty, is that things are not going to look good in terms of unemployment, demand, supply, economic activity for quite some time. Maybe 6 months, maybe longer, maybe even a couple of years. At the same time, I look at the markets. Okay, and let me first of all give a little bit of context of what we're going to discuss right now, which is where should you put your money in these uncertain times or potentially difficult times going forward. Now, looking at the markets, first of all, the volatility index in the US is up 130% year to date. Okay, meaning that it's hugely volatile. It seems to be not an investor's market in the States, but it seems to be a trader's market, in and out and in and out. Then we have all these bad news on the economic front. However, we have, for example, the NASDAQ last year, in the last 12 months, up 9%. Months to date, so all of the April trading days resulted in a plus of 16%, something I think we haven't seen since 1900 something. And also, if I look at gold, year to date up 13%, in a year 31%. What else? I don't know, but I'm looking at these markets and they are looking good. And I wonder, coming from the Corona lows, the COVID-19 lows in March, we've rallied quite a bit, not only in America, but also globally speaking, Europe, Asia as well. Is it the time to buy into these markets for private investors, or is it the time to just wait and see?
It depends on which investors that you're talking to. So the institutional investors, they rallied back into the market with ferocity. Basically, I've never seen such a quick recovery, and we as a firm have been advising top institutional investors with about 7 trillion assets under management in the United States and also in Europe and some in the Middle East. I've been doing this for 37 years. My company is 18 years old, and none of the members of my staff have ever seen anything like this. The question a month ago, if you would have asked a question, I would have said, yes, invest a little bit, but be careful. At this point, we think that from all elements, fundamental, chart technical, consumer behavior analysis, seasonality, we feel that global equities are relatively overvalued to bonds. Of course, with 0% interest rates, why would anybody put money into a European government bond at this particular point? However, in the US, we think that treasuries are going to go to zero. We've been saying that for 6-7 years publicly, and very much ahead of the curve of where other economists and strategists have been. And now, slowly, the last couple of weeks, you heard other people say that, most likely there's a possibility that we could see negative interest rates in the US also. I think it's inevitable. The reason for that is that the entire growth of the United States, the entire multiple expansion of the global equity markets, so GDP growth in the United States and expansion of global equity markets has really been happening because of decline in interest rates and dividend discount models favoring bonds over equities, and then equities following the lead of the bond side. So last year, when a lot of people were predicting that interest rates would actually rise, we were very much of the opposite. December 31st, the 10-year Treasury bond was at 1.85. We were calling for sub 1, and not even having an inkling that Corona could develop to this. That was very far outside of consensus, where we like to be. However, sensibly, we challenge consensus. And the reason why is that we have no inflation. Interest rates do not need to go up. They didn't need to go up 5 years ago. They didn't need to go up 2 years ago. The central banks have been fighting a boogeyman which doesn't exist to the same degree that it existed in prior cyclical expansions.
Let's kind of try to drill down a little bit where you would actually really put your money. So you were saying money is going to continue into equities, if I hear you rightly.
Correct.
Simply because, not because of underlying profit outlook, because we're seeing the first quarter earnings season is already starting to look rather sour. Going forward, the forecast is murky at best. So, however, the flow of funds, there's no alternative. People will continue to invest in equity markets. Now, within that, let's take it as that. Within that, what sort of sectors do you think are the most attractive one? And I don't only mean valuation, I mean in terms of long-term value. Is it the industrials? Is it the technology stocks? Simply because technology might become even more important in a post-COVID-19 world, whatever that is, whether there is going to be a post or not. However, in that new environment, we are going to find ourselves in. Where do you think, what sector offers most value?
Yeah, so Corona has changed the world, and not for 1 or 2 or 3 or 5 years, but really for possibly way over a decade. And consumer behavior is going to change significantly. So from the beginning on, when Corona became a serious health concern, a serious issue, obviously travel, tourism, hotel, restaurants, are going to be tremendously impacted by the behavior changes, and also from a cost point of view, from a security point of view, health security point of view, and also from an overall margin point of view. So those sectors, we don't see at this particular moment from a top-down view any value over the next 3 years in these. Although those stocks are down 50% and even more, like the casino stocks or like some of the cruise operators, nevertheless, we think that to return towards a profitability where they have been, in spite of 0% interest rates and the weighted average cost of capital being where it is, very, very insignificant to operating expenses in general, we don't see any real investment case for these sectors. But then one has to be careful. There are other sectors that are going to be impacted very negatively. As you know, I've been 37 years involved in the automotive sector. It's the second biggest spending that a family or an individual is doing after purchasing a home or after renting a home or an apartment. And we are for 18 months very negative on the automotive sector, and we are increasingly more negative on the automotive sector. I think this is something that is widely misunderstood also in the United States, that the consumer, due to 0% interest rates and the low financeable rates that exist on the automotive financing, that they're going to return towards 15, 17 million annual run rates the way that we have experienced over the last 20 years average. We don't think so. We think, first of all, there are other factors that are affecting the automotive sector: car sharing, better public transportation, particularly now, and then also with all of the likes of the Ubers, Lyfts, and so forth that are offering very inexpensive one-way fares or two-way fares. We think that that is going to have a tremendous impact on the overall sales outlook for the automotive industry globally.
The numbers, if I may interject there, from Volkswagen and Daimler, profits down like 78%. Ridiculous numbers coming through. Okay, so no leisure, no hotel, perhaps no airline business, no car. This all kind of transport,
energy, oil.
However, where do we go? Do we go in gold? Do we go in property? Do we go into technology stocks? I mean, we cannot all buy into Zoom or Netflix or whatever, you know. Question, so where do we potentially find some longer term real investment value? Give us 3 ideas.
Yeah, so how Corona is affecting travel is going to be cost to the travel side, but of course, there will be beneficiaries out of this too. So if you look at UV sterilizers as an example, you know, we cannot imagine that over the next 10 years, we are going back to the liberties in travel that we have had before, whether it's public transportation, whether it's private transportation, but that we are going to have a tremendous amount of added health security, analyzing travelers, whether they have any type of infection before they boarding a bus, a train, a plane, a vessel, And so there are companies that are going to make money out of this. It's not that the entire industry is going to be down, but there will be beneficiaries. And so technology firms that are basically in the spectrum where these transportation, hotel sectors have to step up their security, there's clear gains to be made. There are companies from a Philips to a Siemens to other UV manufacturers that are going to be clear net beneficiaries out of this. Healthcare overall, we think that this is going to be such a changing mindset for investors, particularly within the SRI, within the socially responsible investment themes and ESG, that suddenly the health allocations are going to get a much higher priority than just profitability in the sectors that where Corona is having negative impacts. So from that point of view, we think technology, MedTech, HealthTech, as well as overall financial technology companies are going to be very sought after by investors. Why? Because you have transparency, you have natural growth, and you don't have you have a very fragmented playing field also. It's not like you have a couple of key large players that are going to take the typical Pareto syndrome in a sector. 80% of the profitability, 20% of the companies are realizing them. So we think that equity investors around the world in a much more benign growth environment or negative growth environment will have to become much more stock pickers. And that's something that has been lost in the last 15 years. ETFs have been driving actively managed money to follow the ETF inflows.
Right, it was the biggest rally ever in history since 2008. Basically, that was stopped dead by COVID-19. So that's very interesting. So what do you make, if I may ask, what do you make of gold? Is gold a good bet? Because I'm hearing conflicting messages here. Some people say, well, it will go until $3,000 an ounce. At the moment, we are trading around 1,700 and a bit. Would you go into gold? Would you go into gold directly or through an ETF, as you mentioned it?
Yes. So gold should be a small percentage of any institutional and retail investor's portfolio. However, let's put things in perspective. So I've been in periods of high inflation as well as in periods of massive deflation as we expect it right now for the next 3 to 5 years to be in. Gold is substantial. However, it's an incredibly small asset class. You know, if you look at the size of the commodities spectrum globally is about $20 trillion. Equities are about 70 trillion and fixed income is about 330, 340 trillion. And obviously rising by the minute as the central bankers and everybody else is issuing debt like no tomorrow. So gold, we actually can see gold to go to 5,000 over the next 3 years. Why? Because we are outside of the consensus range with regards to the deflationary impacts that we're going to see. If you look at inventory levels in the United States and in Europe, they are at 25-year highs. The consumers are definitely not going to buy the same amount of TVs, cars, home furniture and offices for surely, and companies are for surely not going to do that either. So there will be massive deflation coming ahead. And then gold should be a much more substantial component of your overall holdings. But, with China being now in a much less favorable growth environment than where they have been for the last 2 decades, and with the renminbi, which they're trying to float via Luxembourg as a hub into Europe in particular, is going to become more important. The US dollar being the central bank global currency as foreign reserve currency will inevitably lose in attractiveness over the next 5 to 10 years. Short term, we might see a rise of the dollar, maybe down towards 102 against the euro, but longer term, with the aggressiveness that the Fed and also has been raising their balance sheet, and with the aggressiveness that the US government Treasury is going to raise through fiscal stimuli, the dollar surely is going to be under pressure
let me just interject there. It's very interesting because I just read a very interesting study about China really using this moment to develop its international reach, simply because they've been the first one with COVID-19, and they're starting not only to help sending masks and sending hospital staff and whatever they can, but really also buying into devalued asset classes across the board. And economically speaking, if you could interpret whatever Trump has done in his presidency so far, he's been make America great again, and let's look only at America with all these tariffs and the trade war that we've seen ever since, especially with China. I wonder whether it plays exactly out the way you say, that the US dollar, the US economy might play a lesser role. So we should be also considering to watch the renminbi a little bit more on a daily basis to just get a gauge on what's happening on the global economic level and activity.
Yes. So whilst now you have a lot of strategists calling for another emerging market crisis to unfold, the way that we have seen it 1998, or the way that we have seen it during the subprime crisis as a consequence. Yes, there are risks. Of course, these economies are more leveraged, and particularly US dollar leveraged via their debt vehicles than Europe is, or than the United States is. However, the currencies are already reflecting that.
Let's finish our conversation, Carlo, if I may, on your take on property. Yes or no as a potential investors class or investment class, considering also that perhaps now as unemployment is going to rise on a global level, but let's speak especially here in Europe and the US, there might be people not able anymore to pay their mortgages. So we're going to see what we've seen in the financial crisis, 2008, 2009, repossessions. You buy, if you have cash, for 30 cents in a dollar into property. Is it something a private investor could consider right now, or maybe not?
Yes, absolutely. But one has to distinguish very much from market to market. As you know, I live in Luxembourg, and there is no more economic value in residential property nor in commercial property for the last 5 years already in Luxembourg. When you look at Germany, the market has expanded tremendously. When you look at Switzerland, the market is expensive. When you look at the United States, the market is expensive. Nevertheless, there are people that own too much home and too many homes. And the same thing in Europe. In Europe, it's much less accentuated due to the fact that we have a much lower percentage of home ownership across Europe. We only have about 48, 49% home ownership per household. And in some markets like Germany, it's even significantly lower than that. When you have net migration inflows, of course, that is putting a floor to the markets, and there's a real need for home ownership, for home construction in many places in Europe. That I am not very worried about the European residential market prices. Commercial is a different story. I believe post-corona, we're going to see very different consumer behavior. I can imagine that large malls are becoming less and less filled. I expect also supermarkets, restaurant chains are going to have to sell due to the fact that they can't get the capacity filled that they need in order to operate in all of their properties profitably. And so consequently, I think one has to be very careful, very discriminate. In general, yes, because you have, to a certain degree, protected renter yields that is going to give you a good yield. But on the other hand, one has to be very selective which market, which country, which area to do those type of investments. But that property in general, yes, due to the yield support that you're getting, but very selectively.
Excellent, Carlo. Thank you so much for your insight sharing that. So what I hear is yes, property, yes, even stocks, be selective when it comes to the sector or the individual stocks. Very difficult when it comes to the entire leisure sector. This is what I'm hearing. Gold, always good to have it stashed away or part of your portfolio. It is a small market, it is a niche market, and again, you can just have it a bit of a security. Cash, I guess, this is what I hear from other people, we didn't talk about it, is always king, simply because opportunities are there, even on an M&A business level, or like I'm doing as an angel investor as well. Valuations have come down, so if you're in cash, you do get a stake in potential companies at a much lower valuation. So very interesting indeed. Carlo, thank you so much for joining me here on Mentor TV and our community. Your insights are so valuable, and well, let's see how it all maps out.
Yes, thank you very much for having me on anytime. And, it will be definitely very telling times in the next 18 months. So let's all hope for the best. And thank you for having me on, Patricia.